What if I told you that silver is setting up for one of the most explosive moves in modern financial history, and the playbook has already been written, not by some Wall Street analyst, not by a hedge fund manager, but by history itself, 50 years ago? Right now, in real time, the same conditions that sent silver from under $2 all the way to $50 back in the 1970s are quietly lining up again. And this time, the math suggests the move could be even bigger. We're talking about a potential run from where we are today, somewhere around $25 to $30 an ounce, all the way to $75. And if the extreme scenario plays out, some serious analysts are throwing out numbers north of $2,500. Now, before you laugh that off, stick with me for just the next few minutes, because by the time we break this down, you're going to see why that number might not be as crazy as it sounds. This is OG John Market, and today we are going deep into silver, the history, the pattern, the math, and what it all means for your money right now. But before we go any further, if you're new here, hit that subscribe button right now and smash the like button. We break down real market history and real investing strategy on this channel, and trust me, you don't want to miss what's coming next. We drop content like this regularly, and your support is what keeps this going. Now let's get into it. Let's go back, way back. 1971. Richard Nixon does something that changes the financial world forever. He takes the United States off the gold standard. What that means in plain English is that the dollar is no longer backed by anything physical. It becomes what's called a fiat currency, a currency backed only by government promises and trust. Now at the time, most people didn't really understand what that meant. But the smart money knew, and slowly, quietly, capital started flowing into hard assets. Gold started climbing. And silver? Silver was just getting warmed up. In 1971, silver was trading around $1.30 an ounce. By 1980, it had hit $50. That's a move of over 3,500% in less than a decade. And the wild part is, that move didn't happen in a straight line. It built slowly, then accelerated, then exploded in a final parabolic surge that left most people watching from the sidelines because they didn't see it coming until it was already too late. So what drove that move? Three things. First, inflation. After Nixon ended the gold standard, the government started printing money more freely, and by the mid-1970s, inflation was running hot. We're talking double digits. People were watching their purchasing power evaporate in real time, and they ran to silver and gold as protection. Second, there was a supply crunch. Industrial demand for silver was growing, mining couldn't keep up, and above-ground inventories were tightening. Third, you had a loss of confidence in the dollar itself. People started questioning whether paper money could hold its value, and when that psychological shift happens, hard assets go absolutely parabolic. Sound familiar? Because here's where it gets interesting. Right now, in 2024 going into 2025, we are watching those exact same three conditions rebuild themselves. Inflation, we've all felt it. Groceries, gas, rent, everything has gone up significantly over the past 3 years. The money supply exploded during the COVID years. That money doesn't just disappear. It sloshes around the system, showing up in asset prices, in real estate, in commodities. And silver is one of the assets that historically absorbs that monetary pressure like a sponge. Now let's talk about supply and demand, because this is where the story gets even more compelling. Silver is not just a monetary metal. It's an industrial metal. And here's something that a lot of people don't fully appreciate. Silver is absolutely critical to the green energy revolution. Every solar panel uses silver. Every electric vehicle uses silver. Every piece of advanced electronics uses silver. And as the world sprints toward renewable energy, the demand for silver is being turbocharged in a way that has no historical precedent. The Silver Institute has been tracking this, and the numbers are staggering. Industrial demand for silver has been hitting record levels. Meanwhile, mining supply has been essentially flat. You cannot just flip a switch and open a new silver mine. It takes years and billions of dollars. So we have this situation where demand is structurally growing and supply is structurally constrained. That's a setup that any commodity trader will tell you is a recipe for serious price appreciation. And then there's the third factor, the one that most mainstream commentators won't touch because it sounds too conspiratorial, but it is 100% backed by data: the loss of confidence in the dollar. Now, we're not talking about the dollar collapsing tomorrow. We're talking about a slow, grinding erosion of the dollar's dominance in global trade. You've probably heard the word BRICS. That's Brazil, Russia, India, China, South Africa, and now a growing list of other nations who are actively working to reduce their dependence on the US dollar for international trade. Central banks around the world have been buying gold at the fastest pace in decades. And when central banks buy gold, retail investors buy silver, because historically, silver follows gold's lead, but it moves faster and harder. In the last major gold and silver bull market, silver actually outperformed gold percentage-wise by a significant margin. So if you believe that gold is going to move higher, and a lot of serious, credible voices are calling for gold at $3,000, $4,000, even $5,000, then silver's potential move becomes absolutely extraordinary. Let me give you the math, because this is the part that will make your jaw drop. The gold to silver ratio. This is simply the number of ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere around 15 to 1. That's the historical norm over hundreds of years. Right now, that ratio is sitting around 80 to 90 to 1. What that means is silver is historically cheap relative to gold. If silver were to just return to its historical average ratio and gold stays where it is around $2,300, silver would be over $150. If gold moves to $4,000 and the ratio returns to 15, you're looking at silver at $266. And if we get into a true monetary crisis, a real loss of confidence in fiat currencies, and silver goes into full panic buying mode the way it did briefly in 1980, adjusted for today's money supply and inflation, some analysts get to numbers that seem outrageous until you do the math. That's where those $2,500 figures start coming from. Not from random speculation, but from looking at the monetary base, looking at historical ratios, and doing the arithmetic. Now, OG John Market is not here to tell you that silver is definitely going to $2,500. Nobody knows that. Anyone who tells you they know exactly where any asset is going is lying to you. What we can say is that the setup right now is historically unusual. The conditions that are in place, monetary expansion, industrial demand surge, supply constraints, dollar concerns, historically cheap relative valuation, these are the kinds of conditions that have preceded major moves in silver throughout history. And the $75 target? That one actually has a significant amount of mainstream analyst support. Bank of America has called for silver in that range in certain scenarios. Commodity specialists at major research firms have published work pointing to silver being dramatically undervalued at current prices. Let's also talk about the short position on silver, because this is something that a lot of people in the Reddit and retail investing community picked up on a few years ago, and it hasn't gone away. There are massive short positions on silver in the futures market. Positions held by large commercial banks and financial institutions. These short positions are not normal. They dwarf the short positions in any other commodity market on a relative basis. And historically, when a commodity is heavily shorted and the fundamental picture turns bullish, the unwind of those short positions can turbocharge the price move. We saw a mini version of this with the Wall Street Bets silver squeeze attempt in early 2021. It didn't fully materialize because the retail buying was not sustained enough. But the underlying short position is still there. And if silver starts moving higher for fundamental reasons, which the green energy demand story absolutely provides, those shorts are eventually going to have to cover, and that covering can create a feedback loop of buying that accelerates the move dramatically. Now, how do you actually position yourself if you believe this thesis? There are a few ways people typically approach silver. Physical silver, coins, bars, stored either at home or with a custodian, is the most direct exposure. You own the metal, there's no counterparty risk, but there's also storage and insurance to think about. Silver ETFs like SLV give you price exposure without the storage hassle, but you don't actually own physical metal, you own shares in a trust. Silver mining stocks are the leveraged play. When silver prices go up, mining company profits can go up much faster, so the stocks tend to amplify the move, but they also carry company-specific risk. And then there are silver streaming and royalty companies, which have a slightly different business model and tend to be a bit less volatile than pure miners. The right approach depends on your risk tolerance, your time horizon, and your existing portfolio. OG John Market always recommends doing your own research and, if possible, consulting with a financial professional before making significant investment decisions. Here's the thing that history teaches us over and over again. By the time a move like this is obvious to everyone, most of the gains are already made. The people who profited the most from silver's run in the 1970s weren't the ones who bought in 1979 when everyone was talking about it on the news. They were the ones who bought in 1972, 1973, 1974, when the narrative wasn't fully formed yet, but the conditions were quietly aligning. We might be in a similar window right now. The green energy demand story is real and documented. The supply constraints are real and documented. The monetary expansion of the last few years is real and documented. The gold to silver ratio being at historic extremes is real and documented. The only thing we don't know is the timing. Markets can stay irrational longer than any of us can stay patient. But for investors with a 3 to 5 year time horizon, the silver setup looks as compelling as it has in decades. So here's where I want to leave you today. Silver is not just some shiny rock that people collect for fun. It is a monetary metal with thousands of years of history as a store of value. It is a critical industrial input for the technologies that are going to power the next century. It is currently priced at historically cheap levels relative to gold and relative to the money supply. And it is following a pattern that, if history is any guide, could produce extraordinary returns for patient investors. Whether that means $75 or $250 or something even more dramatic, the direction of the risk and the weight of the historical evidence both point in the same direction. This is OG John Market reminding you that the best investment you can make is always in your own financial education. Understand what you own, understand why you own it, and understand what the realistic scenarios are, both the good and the bad. If this video gave you something to think about, I want to hear from you. Drop your thoughts in the comments below. Do you own silver? Are you skeptical of the bull case? What's your price target? Let's have a real conversation. And if you know someone who needs to hear this, a friend, a family member, a coworker who's been asking about investing, share this video with them right now. That's the single biggest way you can support this channel and help us keep producing content like this. Like the video, share it, and we'll see you in the next one.